Hey everybody, welcome to your weekend review for the week of Monday, May 15th, 2023. And oh, what a week it was. On Monday, MBS were down 12 basis points on the open. 10-year was up 4 basis points. Stocks were up about 7.88 points. Bonds were modestly weaker in the overnight session with no clear individual market mover. If anything, data made the case for lower rates in Europe. Some highlights were German wholesale prices were negative 0.4 on a 0.2 previous. Eurozone industrial production was down 4.1% when it was down 2.5% previously and on the forecast. An ECB bulletin suggested existing rate hikes will have their peak anti-inflation impact in 2024, so not until 2024. Nonetheless, EU bonds opened slightly weaker and chopped around in a sideways range until U.S. trading began. Some analysts are pointing to stronger earnings offsetting the data implication, but that's a stretch according to stocks. The New York Fed manufacturing data provided a brief recovery with yields almost breaking even on the day, but we've been sliding back into weaker territory since then. New York Fed manufacturing came in at negative 31 point on a negative 18 forecast. It was positive 10.8 previously. Business activity increased in New York State last month, according to the Empire State Manufacturing Survey. New orders and shipments surged while employment remains weak. Inflation continues to trend down with input prices falling while prices received were flat. Pac West is down again pre-market, and we're getting more discussion about banning short-term bank stocks. So there's actually talk about banning bank stocks in general. While bonds made gains on Thursday, the shape of trading raised questions about range-based resistance. Friday's data helped confirm that resistance. The risk-averse crowd would have taken chips off the table on Friday. The more risk-tolerant crowd would be joining them based on today's weakness. On news this morning, Fed President Bostic said that he does not foresee rate cuts at least through 2023, even if there is a recession. Say that again. Fed President Bostic, one of the people that decides this stuff, does not see a rate cut this year, even if there is a recession, regardless of what Fed futures say. Data from Black Knight shows that homeowners have on average $185,000 worth of tappable equity out there. So go get it. Refi. The bond market is increasingly resigned to the fairly boring task of waiting to find out whether bulls or bears will be victorious in this battle over the next big dose of directional momentum. In other words, rates have been range bound and they're ready to go higher or lower depending on the balance of economic data in the coming weeks and months. Indeed, it could take months for the case to be closed. In the meantime, we can only hurry up and wait while periodic flashpoints such as last week's CPI and Tuesday's retail sales make for small-scale volatility inside the confines of that sideways range. We ended the day down 8 basis points on MBS. Stocks were up 12, and the Treasury was up 5 basis points. So at 100.53, we are in a very congested little range right there. We have a floor at 100.281 with 3 ceilings above it that are pretty tough to break through. We also got big news last week that the FDIC is opening up a sluice gate on how quickly it plans to sell off the mortgage bonds it has taken on board from the recently failed banks. $12 billion worth to kick off this week's auction, so they're going to be selling $12 billion extra worth of bonds this week, which is going to mess things up in supply and demand. On top of this, the week's economic calendar offers the NAHB housing market index on Tuesday, housing starts and building permits on Wednesday, and existing home sales on Thursday. For housing starts, the most important component for mortgage and bond investors is that single-family starts, and that has been below the millennium's trailing average of 965,000 annualized since this last July. The latest reading was 861,000.